Hello and welcome to Smartkarma's corporate webinar. I am Anisha Kundu and I lead the corporate solutions offering at Smartkarma. This week we have with us Manulife US REIT CFO Robert Wong and Chief IR and Capital Markets Officer Carol Fong. We will begin the webinar with Carol walking us through a company presentation. After this, Robert and Carol will engage in a fireside chat with Smartkarma Insight Provider Angus Mackintosh. This will be followed by a live Q&A session, so I would like to request our attendees to post their questions in the Q&A tab at the bottom of your screen. During the webinar, I will also share some links on how to connect with Manulife, US REIT, and Angus, so keep a lookout for messages in the chat box. I now hand it over to Carol to take the webinar forward.
Thank you, Anisha. A very good afternoon to everyone who's joining us today. I'd like to thank Smartkarma for organizing this webinar. And I hope we'll be able to share some updates on the US office sector and also on Manulife US REIT. I intend to keep the presentation to less than 50 minutes and leave the rest of the time for our fire chat, as I find that always more engaging and interactive. So let me start off by giving an overview of Manulife US REIT, or MUS for short. So on slide 5 itself, so Manulife is, just give me a minute. Sorry. So Manulife is supported by our sponsor, the Manufacturers Life Insurance Company, which is part of Manulife Group, with an established business in Asia of over 100 years. So what happened was during the GFC, if some of you may recall, I think US and Europe actually took a longer time to recover. And we noticed that the swing factor was much over to Asia that was recovering faster. So Manulife wanted to grow its presence into Asia and decided that the right thing to do was to launch a REIT because of the expertise in their real estate business. So in 2016, they listed Manulife US REIT. And for those of you who are not aware, Manulife is actually in the real estate business for more than 80 years. And the core business is actually in the office sector. So next slide. So this slide actually shows our growth since IPO. So we listed in 2016 with 3 properties with an AUM of 777 million. And today we have 9 properties totaling about close to 2 billion AUM. So we have 6 properties out of our 9 that are actually from the sponsor. So one interesting fact to highlight on this slide is our market cap today stands at about 1.3 billion market cap US, and our trading liquidity is pretty high. Even post-COVID, pre-COVID, we're doing about 3.5, sometimes 4 million a day. So that's our daily trading average. Next slide. So I think the buzzword these days, as everybody knows, is ESG. So what is ESG? So ESG obviously is something that has been big, I think not just in Singapore, but more so in Europe and other parts of the world. And on Manulife itself, we have taken this quite seriously from 2 years ago or so. We put in a lot of efforts to make sure that we do well in this area. So some of the accolades that we want to highlight and share with you. So we are rated A by MSCI ESG ratings. We are first out of 10 Asia offices and 4th out of 15 US office listed REITs by GRESB under the real estate assessment, and first for the public disclosure. And on the Singapore front, we have been ranked very highly among our peers out of the 45 S-REITs and business trusts, 4th for the GIFT index and 9th for the SGTI index. And if you look at the right side, most of our buildings, 8 out of 9, they are either LEED or Energy Star certified. So more details of our targets and our, I would say, our milestones and details can be found in our 2020 sustainability report on our website. Next slide. So what I'm going to do now is just bring us through very quickly the highlights of the financial and operational updates of Manulife. So some of you will have realized that we move away from our quarterly reporting to half-yearly reporting started from last year. And this is in line with our half-yearly distribution. So our capital management itself that we are sharing, that we shared during 1Q result, our gearing, 41.3%, is still way below MAS's guideline of about 50%. We have this year refinanced our loans in 2021 April, and that has brought our interest rate, average interest rate down to 3% and increasing our debt maturity to 3.4 years. But what is even more interesting, I guess, Robert and his team has done a really good job, is we inked the first sustainability-linked loan. So what that means is there are actually some hurdles and some targets. If we do well in certain metrics, we can actually shave off a bit more cost savings. And I think Robert is on this path to get us more of these green loans and sustainability-linked loans. So if you look at our debt maturity profile, we have nothing that's due for this year. Next year, the next refi will be due only in the second half of 2022. And those are actually done at about 3.5% interest cost. So if rates continue to remain in this low level, we hope to get a bit more cost savings when we get to refi them next year. Next slide. So this slide basically gives you a view, slide 10 of our leasing profile, our portfolio updates. So what we have done this year, we have worked very hard to reduce our renewals in 2021 and 2022. So definitely when COVID hit, our leasing was affected. It's not easy. I'll be lying if I say that tenants were very happy and they were willing to pay us like never before. It was tough getting them to even come to the table, show us their check. But what we did was we also have to make sure that we negotiate with some of the tenants. And what we wanted to do is, even though it's hard to get new leases in, what we were able to do very successfully was to renew the current leases that we already have. So what we successfully did was did 5.8% of the portfolio just in 1Q itself. So that's about 273,000 square feet at a positive 2.1% rental reversion. And just a note that our rental reversion includes, does not include, I would say, the annual step up that is imputed in the leases. So for example, if you have a 10-year lease and every year you have a 2% step up, this 2.1% rental reversion is above all the cumulative step up that we have already acquired. And on the left side, you will notice that the portfolio occupancy is still at 92%. So that's still very high versus the US average of about 83% for Class A buildings like ours. And the figure that you're seeing right at the bottom, not to be confused, the 2.1% per annum portfolio rental escalations. What this means is, on average, all our leases actually have a step up. Most of them have a step up of either an annual or a periodic, and that equals about 2.1% per annum for the entire portfolio. So that's more of like where the organic growth is. Next slide. Okay, slide 12, slide 11 shows you our top 10 tenants and also our trade sector diversification. So in our top 10 sector, you will realize that our top 10 tenants, you realize that majority of them are actually HQ listed and they are government. So what this means that these are actually very high quality tenants and they have been paying their rents. Sometimes people look at our slide and say like, oh my goodness, you have 15% or 14% in retail. But if you look at the retail trade, that's about 14%. Actually, don't ask me why, but Amazon is actually parked under retail, but we all know that Amazon is supposed to be more tech. So if I strip off Amazon, the retail is about 10%, I would say, for our portfolio. And the largest two retail tenants that we have that make up that number, William Carter's, they have a shop. I think they have a couple of shops in Singapore, Carter's, and the Children's Place. They are actually in the essential clothing wear. So what I mean by essential is like people like me, during COVID, I can be wearing the same shorts and t-shirt for the entire year, but kids, there's no way, right? You can't stop them from growing. And the sales of actually our retail tenants have actually been better than expected. The e-commerce has actually jumped quite a bit. So I think we are quite heartened and we continue to look at the space very closely, but so far they have been paying their rents and they are doing quite well. Next slide. So before we move on to the next section, which is the COVID-19 updates, I want to take this opportunity to get a very quick poll from all of you. We have a couple of questions that we want to ask. You have about 30 seconds to do that, and we will share the findings with you shortly. So just take your pick, 1, 2, 3, or 4. I should do that too, right? Let me see. So about close to 40% of you states that you want to work from home 1 to 2 days per week. The remaining actually wants to either do 3 to 4 days, and 21% actually wants to work from home forever. Wow, interesting findings. And just have this mindset. Just remember the numbers that you're seeing here for a second, and let me just run through what the couple of next few slides will be. So most of you know that in Singapore, work from home really started in, I would say, March, April 2020. In US, it's actually been around since 1990s. So that's something quite different. Most of my US colleagues actually have the option to work from home. In fact, 30% of Manulife staff actually work from home in US. Very envious, right? Yeah, me too. So what this slide actually shows, what I wanted to share with you is if you look at the slide, the chart on the left, this is actually one of more interesting surveys that I've seen, because this survey that's done by PwC on the left actually gives the view from the bosses or the employers. So a lot of people, a lot of us who may have taken the survey earlier should or could be considered under employees. But the employers actually during this survey shared that 75% actually felt that half or more of their staff should be back in office by July this year. So that's what the employers think. And what is very relevant and important to us as an office REIT is 70% of this decision makers. So these are the CEOs, your chairman, your senior execs, your C-suites. They actually expect the physical office space to remain the same or increase. 70% of them actually feel that way, right? So this is something that is it's quite encouraging, because it means that office is still relevant. There's still going to be a use for the office space. And the chart on the right, actually one of the more recent charts by Green Street, they have collated this survey that is actually from the employee's point of view, whether how many days do you want to be in office, or do you want to be in office for good, or you want to stay at home for good. And this findings is similar to what I have asked for all of you to do the survey. So if you look at the difference, right, I think the 1 to 2 days work from home figure is maybe okay, not that different, not that much, but the always to work from home is 15% versus the Singapore. I don't know how many participants we have now, about 100 or so. So out of the 100 of you, majority of you have chosen for 3 to 4 days or for work from home forever. So for this, the US model, they actually surveyed quite a lot of people, and this is the result that shows that employees still want to work in office, but for 3.6 days. So what is encouraging also is that majority of the time will still be spent in office. And what we believe and what we are hearing is offices will become a hybrid. Now it's kind of like given, not given. If you ask anybody, most people kind of like the office to be a hybrid model, whereby I can go back 1 to 2 days a week for meetings. And then this phase that has become quite popular, gather and scatter. So you gather for meetings, for brainstorming, for ideas, and then after you scatter, that means you go back home. You don't have to stay in office the whole week or the whole time. So that was something that we saw from the survey. Next slide. And I guess this is something that most of you may have seen from the papers and the clippings. So this was all the recent clippings in the last couple of weeks that we have seen from US itself. So I think from last year when work from home started, a lot of the tech giants actually came out and said that, oh, employees can work from home forever, like 100%. And then we in Singapore were just like green-eyed monster and say, oh my goodness, like me too. But what has happened recently, right? If you notice, some of them has kind of like retracted their statement. You have the bank saying that there is actually a drop deadline for workers to be back. So everyone has said, so Labor Day is actually in early September in the US. So everyone has given their employees that you have to be back in September. So that's something that we are seeing in US, and more of the, I would say, the bosses and employers are telling their staff that. And if you look at in our own portfolio, so Manulife has 9 properties, and during COVID, actually all 9 of our properties were open. The reason why I would say the occupancies didn't climb as much as we would like it to be is very different from Singapore. The schools in US were actually closed. So when you have the schools closed, and in Singapore, you could have helpers, you could still have helps, right? Put them in your parents' place, or find a nanny, or put them in your preschool. In US, this is not an option. So with the schools being closed, parents can't go back to work when they have kids. And with that, I think also a lot of parents were working from home. And that kind of like delayed the return to office. And the schools in US only started to open in May, June this year in phases by different states. So that's a bit different. So if you look at our occupancy, that is a bit low. But as we speak now, looking at June's number, that has continued to climb, because if you have been following the US vaccination story, the vaccine rollouts have been quite fast and furious, which I'll share in the next slide. So looking forward, what does it mean for Manulife? So pre-COVID, the main criteria that we have is we buy high quality trophy Class A properties in locations that's live, work, play with amenities and strong fundamentals, high occupancy, important, long WALE to provide the stability as a REIT. Post-COVID, what we have learned. So we have seen the migration of the population, to more I would say, Sun Belt to the West Coast. Higher standard of living is not preferred, more densities. People are kind of like moving away from that. So the growth is also coming from the tech sector, the healthcare. And with the two combined, I think that will make us in a better position. And because we have built our IPO portfolio till today, very high quality trophy Class A tenants and also portfolio, we can now take a bit of growth sector. And of course, with growth, it always comes a bit of volatility, but there could be, upside or downside. But we could now take that kind of growth added into the portfolio to give us a further thrust forward. I think I'm at my last slide. So lastly, just to share on what's happening on the US, I think first Q's, the GDP growth is still very strong, 6.4%. So most of the states in US are already fully reopened. I think by next week, 8 July, all of them will be fully reopened. So the 50 over states in US fully reopened. So unlike us, my colleagues in US are really not wearing their mask if they are vaccinated, and they are very busy planning their parties, their dinners, because they have actually been at home for 1 year. A bit different from us, because in Singapore, you have team A, team B, you can still go back to office. But in US, it's really quite different. And for the states that we are in, for Manulife properties, all the states are reopened, and we continue to see employers and the tenants sharing with us that they all have a deadline to kind of like be back by September. So that's quite interesting. So with more than, I would say, 50%, close to 50% fully vaccinated, and I think that rollout is quite fast. We hope that will also mean improvement in the business sentiments in US, and that should actually work quite well. So versus, I would say, some of you may think about, like, does it really make any difference and what's happening during COVID? Compared to the GFC, I think GFC took 10 years to recover. Some people say that, the US is still recovering from GFC. The key difference was during GFC, there was very little help that was given to the SMEs, to the businesses. No money was pumped in. Fed was not really involved. They were trying to survive. But this round is very different. If you have read about the trillions of stimulus that was given, and the government is doing everything and anything that they could to really prop up US, this is a very different scenario, and which leads to why even during COVID, there was no distress sale. We were so excited when COVID happened. I mean, for the right reason, right? Because we thought that we could have done acquisitions, there's so much that we could do. But everybody kind of knew that this was going to be a blip, not like the GFC when it took a few years to recover. So everyone was holding their prices quite steady. So that gave us a little bit of difficulties actually in acquiring, because we wanted to buy at COVID price, but everyone wanted to sell at pre-COVID price. So there was a bit of a mismatch, and we wanted to make sure what we buy still has to be accretive. So looking ahead, I think, it's still, I wouldn't say that COVID is we are out of the woods, COVID, we're still in the midst of COVID. It is still a tenants market. Tenants are still asking for higher tenant incentives, free rent and all. But what we will be doing is, I think since Biden has come on board, I think he has done quite a lot of good. His 100 doses in the first 100 days, which he promised, he has, I think, under-promised, over-delivered. And that has changed, and I think that has been quite a booster for the US economy as a whole. And if you look at what we want to do moving forward is shared earlier in the earlier slide, we want to grow at least 20% in the high growth sectors as well we are targeting. And at a 2 billion AUM today, we are 5 years old, we are looking for, I would say, bigger deals to bring us forward, not just single acquisitions, which we will still look at, but we're also open to looking at portfolios. We are exploring JVs and NMA, and hopefully that will bring us to the next frontier. So with that, thank you, and I'll open now. I think I'll pass it back to Angus.
Carol, yes, thank you very much for a very, very clear, succinct presentation on Must. I might just start the questioning with a very simple question. Why was Must initially listed in Singapore, given that all the assets are in the US?
Yeah.
And does that work with the underlying client investor base for Must? And give us an idea of how that breaks down would be great.
Yeah, I mean, if I could, I would have asked for a show of hands. Usually I'll ask how many of the participants are actually shareholders of Manulife. But I mean, since I can't, I just want to share, I think some of you who would have followed us for a while, I think as shared earlier, 2015 was the year when I think Manulife decided that Asia is really where we wanted to go. We started to do not just the REIT IPO. Some of you may recall that Manulife inked a 15 years deal with DBS, kick out Aviva. So whatever DBS is pushing out now is all Manulife products. Did the same in Hong Kong Stanchart. And there was this big push, Manulife entering into Asia. And they were so serious that they bought the old PwC Tower, which is where our office is right now, 8 Cross Street, because this is where they believe that they should be. And Singapore is the obvious choice because it is a REIT hub. It's a place recognized for international REITs. And some people actually ask, like, oh my goodness, Manulife, you're so big. Why list 3 small little tiny properties at such a small market cap? But if those of you who have been in the stock market for a longer time will recall that there was actually not really any IPOs prior to 2016. The stock market was quite dry. There were very small IPOs that came on. And actually for us to raise about 450 million US is quite a lot. Because of our structure, the sponsor cannot hold more than 9%. So we only had 5% which the sponsor held, and the rest has to be raised. So we wanted to do something in a, I would say, disciplined manner. And listing in US is never an option. There was no need to list in US because we are very well known in US. So it was mostly about the profiling, branding, bring a product to Asia that drove the sponsor to do that. And our investor base, for those of you who are shareholders also, I mean, thank you for your support because we wouldn't be here if not for you. When we first got listed, I mean, I always share with my peers and whoever I met, this is the hardest IPO I've done in my life, having done a couple, because we were the first US REIT in Singapore. And when we first got listed, I would say that 80% of our investor base were actually retail and high net worth. So PB clients, retail, high net worth. The insties didn't believe in us at all. They were like, you guys are trying to smoke me, bring 3 little properties to list. And then it was hard, right? And it took us quite a while. We had a strategy that we had in mind. We had to deliver the results. And today, if you ask me, we have about just over 50% of investors who are insti. So we changed our investor base, getting into the NARI index, doing a lot of thought leadership, things that other REITs don't really focus on or don't need to, because everybody know where Singapore is. But once you go into like Irvine, New Jersey, like Secaucus, people are like, oh my goodness, where's that? And of course, it helped along the way, along the years, more and more US IPOs came. And the very big boys in Singapore started to acquire into US. It's like giving us a rubber stamp that says US is the right market to be in for real estate. So that helped quite a bit. And we have quite a bit of diversification in our shareholder base. One third from Singapore, 1/3 actually from Asia. And the rest actually split between, we have like US, we have Europe, different investors that we are seeing, including the hedgies, which is a very small percentage, mainly the long only. Index funds, we have quite a bit because we are in some of the index funds, including the ESG indices, the NARI index that we are in, the MSCI. So we have about 25% of index funds.
Right, yeah. Very interesting. I mean, I guess to some extent there's a kind of search for yield, given REITs are very high yield instruments, so very suitable for your low yield environment basically. Well, let's sort of move on. I mean, you've already talked quite a bit about the impact of the pandemic, and from sort of the outsider's view, looking at the US, it does seem as if they've made a lot more. They're making very good progress, especially in vaccinations. So that hopefully will mean that things go a little bit more back to normal. But possibly you could expand a little bit more on that side of things.
So you're talking more on the vaccination impact and
yes, and you've also talked about the fact that people going back to the offices won't be the same as they were pre-pandemic. You're probably going to need more space per employee and all that kind of thing.
Yeah. So this question actually we got a lot, at the start of COVID, because everyone in Singapore was convinced that office is dead. Because I have friends and family who suddenly told me like they can work from home for good. I'm like, are you for real? But I mean, it is real. So with that lens, I think a lot of people is thinking that this is how life is going to be. But I think what is forgotten is in US, actually to just even take a couple of steps back, co-working started in US because people were already working from home. So if you have like 30% of your workforce working from home, you don't need 10 tables, you need maybe 8 tables, right? And then whoever comes in, plug and play. So that actually took off in US many years ago because of work from home. So work from home started in US since the early 1990s, and 54% of Americans already have an option to work from home, unlike in Singapore. And this is pre-COVID. And the latest stats I have, I think 35% of Americans already work from home, majority of the time, right? So co-working made a lot of sense because then you don't need that kind of space. So what we are seeing is this work from home issue will impact US definitely, but what we are convinced is it shouldn't be in the double 4 digit that it's like from 0 to 20%, because people already had an option to work from home, unlike in Singapore, right? In Singapore, like for Manulife US REIT, working from home was never an option. Like it's more like a Singapore culture. It's like, what is that? You're not like a freelance designer or something. You come to office. So I think that was a very different, I would say, culture, if I may. So we were very envious of colleagues. Our tax advisor in US, whom we engaged since 2015, he never had an office. Works in a legit law firm, never had an office. So they're very mobile. So we think that with the vaccine rollout, people can't wait to get back to office. So my US colleagues were like, even my CIO, Pat based in New York, he's going crazy at home. He has 3 young kids. He has never stepped into office for the last 1 year and like 3 months. He's just home every day. So unlike in Singapore, right, we have like team A, team B, Robert's in team A, I'm in team B. We can still see each other, like have adult conversations. So that's pretty nice. But for them, a lot of them really can't wait to get back. But what we don't know is, we don't know how many percent, what's the incremental, that now want to work from home forever. So maybe from the 30% that has already been working from home, perhaps incremental is another 5 to 10%. We don't know because people are not back yet. So that's something that we have been watching very closely. But I don't think it's from the Singapore's context whereby, like now in office, DBS gave that quite a lot of space. They are encouraging some of the backend staff to, like work from home, or if you can, because that was never an option also. So we hope with the next reopening that's currently ongoing by September, we should be very clear, because once you get back to office, then as an employer, I can kind of like decide, right, how much space I need. But what we also believe, because when I went to US for my site visits, right, visiting my office, it's like, oh my goodness, the offices are done up so nice. They have discussions over a bar. Like they have like lazy beanbags on the floor. Everyone's like lying around having a meeting. Will that change? Perhaps. Because I think now you may want to just have like smaller rooms so that you can still isolate people when you come for meetings rather than have it over a cocktail table. So we are also hearing news that they may need to look at the social distance, the 1 meter, especially for the banks, very strict, right? The FIs, they may need to look at that. But it's a bit early days, which is why we really were waiting for them to go back to office. Yeah.
So in fact, you might end up having a much higher occupancy rate as a result of the new rules on space allocation for employees and so on, depending on the type of company.
Correct. Oh yeah, and I think one more thing to give some color is, I think like last year to this year, post COVID, when COVID started, we had about 30 odd renewals that were due, leases that were due for renewals, and out of the 30 over leases that were due, right, only 3 to 4 of them didn't renew because of COVID reasons, right? So they didn't renew because one of them was it's a cookie at the first floor of the building where they sell cookies. So F&B is definitely affected. We have a association, a cataract association, society. So those didn't renew for reasons that were COVID related, but it's not like half the renewals didn't go through because they were COVID related. Yeah, right. And in US, the leases are still very long. No matter how people still like to do the 5 to 10 years, unlike in Singapore. Yeah.
Yeah, well, that's very defensive. I've actually there's a question come through here, which you've actually already answered, which is, how will the work from home trend affect Must? Which I think we've already answered that. I'll get on to some of the other questions in a short while. Before I do that, I'd just like to sort of move on a little bit, just to discuss in a little bit more detail. What are the key features of the buildings within your portfolio, and what makes it, what's makes it a very strong portfolio of office property?
Yeah, that's a very good question. So I'm not sure how familiar the audience or Angus you are with Class A versus Class B and trophy. So in Singapore, a Class A property will really be like your MBFC, your ORQ, whereby it's about maybe 5 to 8 years old, kind of aged glassy material. Trophy basically is the best of the best. So like the newest, like Boko Tower, One Marina, those could be considered as trophies. So they're the best of the Class A. Class B will be a bit more inferior, whereby you have a smaller floor plates. So there are more columns. The height is a bit shorter. You don't have that much window space. You may have to peek up just to look outside. And if you are a very big company, you want all your staff to be on a single floor plate with like 100 staff. You can't do that with some of the Class B properties. So in Manulife history and DNA, we have always thought of Class A and trophy to be the most resilient, because to be in a Class A, you pay a slight premium to the Class B. So when you pay a slight premium, you get the companies that are listed, HQ, government agencies, right? There's a bit of prestige to it. And during any crisis, I think in the past, what has shown is these tenants actually survive better because of their credit rating. And I mean, as a listed company, you may feel like, okay, and just to give a bit background, right? If you're a New York company versus in we are not in the gateway cities, there's like New York, Boston, San Francisco. Because if you're in a New York, San Francisco kind of properties, your rents are about $80 to $100 per square foot. Our property on average is about 35 to 40 per square foot. So rent is not a huge portion of your expense line. So when you have a crisis like COVID, you don't return space because it will not move the needle. You may not be able to save much business. If you return space, the signal that you're sending to your shareholders may also be a bit scary. So when we look at Class B itself, Class B is also usually in not such a good location, no train lines, no bus stops, not much amenities around. So that's how they sometimes distinguish between the Class A and Class B. And of course, who is the property manager? Some buildings in Class B, you can be stuck in the elevator for 3 days and no one's going to save you.
Exactly. Well, I've got quite a number of questions coming in, which actually are quite relevant to what we've been talking about. So I started with one here. I note that 6 out of 9 of Must's properties have an age of 30 years or older. May I know, what the REIT managers' view on the maximum useful life of office buildings before considering redevelopment of these properties or capital restructuring? And this is from Tommy Tan. Yeah,
just looking at the question now. Okay, I'm going to take it and then maybe I'll let Robert just add in a little bit. I just wanted to give a bit of context also on the age of the buildings in US and a bit of the difference. So when I first joined the company, I was horrified. Like, how come some of our buildings are more than 40, 50 years old? Because in Singapore, after 10 years, you get en bloc, right? You just demolish and you rebuild. And in US, what happens is the inside of the building is actually very, very well kept. They actually spend a lot of capex, a lot of tenant improvement dollars to uplift the inside. So when you walk into like a 30, 40 years old building, even the marble flooring has been replaced. The lift lobbies, the lifts itself are upgraded. So the maintenance done is very high. And those major ones that is, I think, for sharing and the main facades and all those are actually being paid by the landlord, which is like the REIT. the tenants themselves, when they come and move in, they are also actually given an incentive to move in with like reno incentive subsidy. So they can really have like state-of-the-art kind of like really nice insight. So for Tommy, I just urge you that if you have time, go look at some of our property videos. We have, I think, 7 out of 9 of the property videos on our website. So you can have some sense of how the inside of the building looked like, because I was very impressed. So when our sponsor first bought 8 Cross Street, right, the ex-PwC building, I was so upset. I was like, who buys such an old building? My goodness, I'm going to tell my friends it's terrible. But they actually spent quite a lot of money doing the inside, which after that I realized, oh, actually it's pretty decent. It's not that bad. Yeah. So that's just a bit of context. And there's no need to, I would say, demolish or rebuild from that aspect, because the upkeeping is actually constantly there. So I don't know if Robert has anything to add on, like how you look at, the buildings in Singapore.
Thanks, Carol. I think well said by Carol. I think there's constant kind of refresher and renewal of the building, the facade, the lobby, the lift upgrade. We've done quite a few of that. So that kind of extend the lifespan of the buildings. And that Carol has shared that the tenant incentive that we provide to attract the tenants is not only a fit out within their premise, but the lobby areas, the toilets, all the fittings and around, especially for those tenants that are going to lease out a full floor, we'll grant them usually a fairly generous tenants improvement incentive for them to anchor themselves for very long leases, right? So they kind of constantly renew and refresh the buildings. And one thing you got to be cognizant of is that construction cost is very high in US, right? You may see empty land adjacent to it, and you wonder why is that no new buildings popping out? Because it's just too expensive. It's like maybe equivalent if you talk about retail malls that is been demolished or major refreshment done to the buildings. You see an increase in rental, a sharp increase in rental, right? And that may not make it economical for competition to come in, buy a piece of land and build it out. So our building, so some of them may be a bit older, it is still very relevant. And in terms of rental, it's still very competitive and attractive for tenants. And they're all generally well-located locations, not in what Carol described, Class B locations, which is a bit harder to get to, or the building configuration is not as well done.
Thanks, Robert. Yeah, there was actually another question here which is relevant, which you probably partially answered. But will Most look into investing into purchasing new properties? If yes, will it be in the near term, i.e., within the second half of this year?
Yeah, no, I'm just trying to find that question. So I assume the question is just in acquisitions in general, right? New properties. That's what they mean, right?
Yeah. Well,
okay. Is that the question?
It's saying purchasing new properties. So whether
so should be new acquisitions, yeah. So just to answer the question, I mean, if I'm not answering correctly, just drop me an email or let me know and we can follow up. So when we look at acquisitions, first of all, I think Robert shared briefly, to look at a brand new property, first of all, it's the yields, what you can generate. Can we make it accretive? That means after buying it, we must be sure that it's better off for unit holders like yourself. If you buy a very new property, then you have to get a very high rental, and the cap rates for the properties may not be able to justify the acquisition. But if you're talking about us just doing acquisitions, yeah, we have been looking at properties like day in, day out. And actually, I always joke, like last year, you will hear me say this very still joke, work from home is like working forever at home. I mean, I think I went mad for a few seconds, and then once in a while, I just needed to get out of the house. We worked so hard because there were so many deals in the market. We worked like day and night looking at portfolios, looking at single acquisitions, trying to make the numbers work, trying to see whether it's the right location. We don't stop looking, but I think what has happened is throughout the months, we haven't been able to find one that the numbers actually make sense. Like I shared, the value of the properties, actually what they are trying to sell is pre-COVID price. And some of them does not make sense. So everyone is just trying to, like ask for the sky. So we decided that as a disciplined REIT, and I think we have said to shareholders many times before, that we only want to do accretive deals. So when we were trading at close to 8.5% yields, to buy anything and make it accretive was not easy. And those that we saw that could work weren't going to be properties that will stay right for the REIT. Yeah. So I'm not sure if that answers the questions of acquisitions.
That sounds fair enough. There's another one here which is also related, and it's more about your long-term strategy. From Joseph Tay, basically saying what are Must's strategic plans to diversify its portfolio in the longer term, and if these plans have changed since the start of COVID, and how is Must also pivoting to capitalize on emerging themes, like last mile logistics, centers, etc.
Yeah, saw that question. Thanks, Joseph, for the question. So it's a great question. I think what we have done is, I think since last year, we actually, interestingly, to Joseph's point, we started getting a lot of reverse inquiries from investors asking us, are we looking at logistics? Because logistics were the darling of the world during then. And we look at everything. And there is no stopping us entering into another sector. After being listed for 3 years, there's no need to call for an EGM to enter into another sector. But what we need to make sure is whatever sector that we are looking at, maybe a logistics, data center, or you listed green tech kind of like theme, the price must make sense for us. So we have now 9 properties. We are listed for 5 years. Is there a possibility? I think you talk about diversifying the portfolio, and we could do some divestments of sorts to tweak our portfolio to match some of the themes. Those are all considerations that are up for considerations that we are looking at. And I think as shared, I think we are now 5 years old. To buy a property at 100 million, it's going to take a while to jump to the next level. When you're small, it's easier to grow. When you're big, you have to grow much bigger. So we are considering all those. And I think what we have added post-COVID is really the post-COVID themes that we are looking. So just to share, for example, I know I'm recorded. So in the past, we never look at warehouse. We never look at, say, a single, I would say, standalone property in a business park. So let's say, for example, right, you have a #1 tech company in the world, single tenant in a business park. The numbers make sense. We used to not look at it because we feel that a single tenant is not the right risk profile that we want. But now, having looked at what has happened during COVID and looking that the tech theme has been very strong, and knowing that we have already built a solid foundation of very stable and resilient tenant base, we are open to looking at single tenant. Like if you are, we wouldn't say no to you if you are Google or Facebook. We will look at basically the price, the location. But what we are doing now is we will at least consider. So last time in the past, we were like, nah, not for us at all. So I think that has changed. If you're asking me a bit of like what that mindset has been.
Right. Very good. That's quite clear. And I think there was also the same question from Vivian Goon, which I think we've answered. Moving on to, there's quite a number of questions here. I'm just trying to sort of fit the next one into the right thing. So we've done that. There was one question, very specific, just saying one of the earning laggards in Must's earnings in 2020 is income from management of car parks in property zones. Has this segment recovered during the first half of 2021? From an anonymous attendee.
Robert, you want to take your favorite car park question?
In short, not just yet. As Carol has shared, only about 20-25% of people are going back to office, and the car park is very much dependent on tenant utilizing the car park, and also the surrounding convention centers or entertainment centers that utilize our car park. So I think that will naturally recover when people start to go back to office, and likewise that will also support our F&B's tenants, which account for about 1% of our gross revenue income.
Right. Okay, very good, Robert. Some other questions here, which I will add in. This is actually an interesting one. So yeah, how does a US REIT compare to a Singapore REIT in terms of returns and stability. And also, I would add in, there's a question also looking at US tax and how US tax laws affect the company's distribution.
Robert, you want to take it?
Yeah, probably I'll just, I'll address the tax aspects of it. I mean, in short, compare the Manulife US REIT that's listed here in Singapore, then the US REIT that's listed in the US, is that we pay out 100% of our distributions. And under our trust deed, the baseline that we're to pay out is at least 90%, right? Whereas US REIT listed in US operate quite differently. They do not have a payout of 100%. It's at the discretions of management, and they generally reserve cash to fund their capex. And for those US REIT, they generally don't tap the market as frequent because they're holding back cash. So when you look at investing in the US space, you're looking at more of a total return. I mean, you don't get the cash yield like you get from the Singapore REIT, right? So in a way, our capital structure is a lot tighter, and the discipline required to constantly trying to get, the earnings recurring, to milk the rental escalations, and to buy things accretively in order to create a sustainable income line is particularly challenging, right? Now, on the tax front, if you were to invest in US, there will be US REIT, there will be tax. But if you invest in Manulife US REIT here in Singapore, you essentially pay no tax. Now, how do we do that? It's the way we formulate our capital structures into the US onshore. They comprise of two limbs. One is the capital injections. The other is the shareholders' loan. By and large, a lot of the capital injection is in the form of shareholders' loan. Now, the shareholders' loan will be accorded a much higher interest rate than your traditional bank loan, third-party bank loan. So it's in a high, 7, 8, depending on the transfer pricing assessment at that point in time. So the shareholders' loan interest and building depreciation at the US level is very effective in shielding US income from tax. Not to say that there is no tax. All we've done is very effectively shield it from tax. And so any income earnings is repatriated out of US, again, it's come out in a form of shareholders' loan interest income and capital returns. And when it lands here in Singapore and pay out to the unit holders, the Singapore authority do not tax distributions.
Yeah, so if I just sum up, I think in layman's term from what Robert has shared also, right, is if you buy a US stock today, you have about 30% tax on your distributions, right? So your yield is from, I don't know, like in US, the REITs on average give about a 3.5% yield, 4%, to be very generous, 4%, you get 70% of that. So you end up with just over 3% or lesser than that kind of yield. You buy a Google, a Facebook, any US REIT is the same as a 30% withholding. But if you buy a US REIT listed in Singapore, you actually get your full, so today we are trading at about 7% yield. You get your full 7%, no tax. And for that reason, which is why now we have 5 US REIT listed in Singapore. So we kind of opened the floodgates for them. And I think MAS was very hospitable and open for us to come because it means quite a bit of difference, right, to the financial sector. Yeah.
Very interesting. Here, there's a question from Velvin Goon saying, why is there such a big yield discrepancy between Must and Singapore office REITs?
Must and Singapore office REITs. Okay, I mean, actually that question we have been trying to ask and answer that for the last few years since we got listed. I think that the key difference is really because of the unknown and size. So if you look at a REIT that has been listed in Singapore, you walk around, you can touch the building. You walk into ORQ, you know who owns it. You walk into Suntec, you know who owns it. But when I tell you that my office building is in downtown LA, right, or even in Capital Sacramento, it's tough because first of all, you don't know, you have no idea, you have not heard of the city before, and then you give a discount to the unknown. And of course, you're not going to wake up at strange hours just to follow the news. And whenever there is fire and earthquake, or usually it's fire, in California, I get a ping on WhatsApp, like, is it near a building? Then I have to go to Google Maps and say, oh no, it's not near my building. So those are like one consideration. And of course, the other one is, end of the day, there's always a premium that's given for home REITs. Also because it's Singapore, right? So there's no country premium, there's no country risk across. There's currency also, Sing dollars versus the US dollar. And we are doing a lot to try to kind of like narrow it. And sometimes it's just perception. When you are not sure, you go back to what you're safe, what you feel very secure with. We hope to close the gap. I think we did that, I think, when we got into the index. I think when we show people our track record that we are here to stay, we're doing what we have said that we would do, right, in a disciplined manner. And that's something that, actually my directors, the person sounds like my director, I hope it's not my director in disguise. We get asked by my directors every day, why are the Singapore REITs trading at 5% or so and you are trading at 7-8%? Are you doing your job? What are the investors not getting? I'm like, this is just how it is. Even if you look at, I think Singapore has about 1/3 offshore REITs, if I'm not wrong, right? Yeah. If you look at the offshore REITs in general, they're all trading at a bit of a discount versus the Singapore REITs. That's given. So there's always a risk return that we have to take into consideration. And perhaps when we get so big one day that we get into the STI or even the MSCI index, I think that game will change.
Right. So it's basically an offshore risk premium on.
Unknown. I don't know. And we hope that will narrow.
Right. Well, we're getting very close to the end in terms of timing. One question here, I think we could probably link to something you said earlier, is how much cash in hand, or I guess what's your capacity to make acquisitions in the future?
Yeah, I can take that one. I think at a current gearing at 41.3%, just indicatively, I mean, versus the MAS debt headroom of 50%, that's a debt headroom of 363.1 million. Obviously, that doesn't mean we're going to spend everything and ramp out our gearing. Just to give you a sense in terms of what we have done in terms of debt capital management, we prepare for growth. I mean, there's basically no refi this year. We have RCF that's clean, untapped, 100 million available right now. We have just recently obtained another unsecured acquisition bridging line, 200 million. So it's all available to tap once we see a deal that meets our accretion hurdles, right? Obviously, the main thing is what Carol shared, is the cost of equity, right? The cost of capital raising is making acquisition a bit difficult at the moment because we don't see COVID pricing for the real estate out there. Yeah.
Not enough distressed sellers at this stage, anyway.
Correct.
Well, very interesting, and thank you both very much for a very clear answers to all the questions. Hopefully we've covered most of them. There are a few outstanding, but I think we already covered those areas. At this stage, I'm going to hand back to Anisha, who will close the proceedings. Thank you very much.
Thank you so much, Angus, for those very intriguing questions as well, and Robert and Carol for giving us insight into Manulife US REIT, as well as the US landscape and the future goals for the company. I'd like to thank the audience as well for being very engaging and sending all your questions through. So with that, I will wrap up today's corporate webinar, and everyone have a good week. Thank you so much.
Thank you.
Thank you. Bye-bye.